Number 2 in our 4-step plan of protecting your portfolio in a bear market is to trade short. You've probably heard about it. A lot of people get confused by this. I'm going to make it really simple. A short trade is just simply a trade which profits when the price of an asset falls. Now, typically it involves borrowing the asset, selling it into the market, and then buying it back at a later date, hopefully at a later price. Now, this is a schematic that I've created for my bear market survival guide, right? It's an ebook. It's got about 36 pages in it. It talks about all this stuff in incredible detail. Again, I'll provide the link in the YouTube post below. It's free to download. Make sure you get that. I'm going to keep it simple here. We're going to take the simple path, but I did want to put this in just to illustrate the complexity of traditional short selling. And it is generally restricted to your large and institutional investors who have access to stock lending pools, the ability to go to big investors and borrow the stock off them so they can then sell that into the market. Traditional short selling is complex. The way I suggest you do it is to investigate these financial instruments called contracts for difference, or CFDs. All a CFD does is replicate a transaction in an underlying asset. Let's say a stock, for example, but we don't need to borrow the asset, okay? We just go through the process of the transaction. Now, CFDs have gotten a little bit of a bad rap from time to time in the past, but generally because some investors have lost money using them. And the potential problem here is that you can lose more than your deposit on a CFD trade. So let's say you put a deposit down of $500 to do a trade. If you don't manage your risk correctly, with discipline, with stop losses, you could lose more than that $500. Now, Think Markets, we have a system called negative balance protection to protect our clients from that ever happening, but it might not be the case with your other CFD brokers. Look, the message I have for you here is this tradesman using that circular saw. He's got all the protective equipment on. He's had all the training in using that circular saw. And what that circular saw does for him is it does the job faster, it does the job quicker and cleaner than if he was using the old-fashioned handsaw. Now, should that circular saw, should there be a mishap, lapse in concentration, and he knocks a couple of fingers off, I don't think you can blame the circular saw, okay? It's not the circular saw's fault. It is always the person using the tool's fault. CFDs are just a tool, ladies and gentlemen. Don't blame the CFD. If something goes wrong, I think you need to blame the person using it. How can we use CFDs to trade short in the market? Well, just very quickly, the old-fashioned buy, hold, and hope approach would have us going onto our stockbroking platform, finding the stock we want to buy, entering the amount of stock we wish to buy, and then hitting the buy button. At some stage, hopefully the price goes up. That's what we want. We hit the sell button and we make a tidy profit. Fantastic. The opposite scenario, we know that all too well. In a bear market, potentially, the price doesn't go up, it goes down, and we sell at a loss. Okay, let's flip everything on its head and do the short selling now. If you're using a CFD, for example, with Think Markets, you head into your Think Trader account, you find the stock you're looking to short. Hey, it might be Tesla if you're trading US shares, it might be BHP if you're trading Aussie shares. Once again, you enter the amount of stock you wish to trade in. This time, though, you hit the sell button. And we don't have to worry about any of those complicated stock borrowing, stock lending arrangements. Your CFD broker understands that this is just going to replicate a short trade, and you'll settle the difference of that trade somewhere down the track. And the other thing which is self-evident for the broker is that you are hitting the sell button first. You don't already own this stock. So by the very fact that you're hitting the sell button first, it tells the broker that you are initiating a short trade. Now, somewhere down the track, the opposite needs to occur, and the opposite of selling is buying. Also opposite is our payoff dynamics. So this time we want the price to go down. If it goes down, we're going to make a profit. But if it does happen to go up, we're going to make a loss. And we need all of those exit plans that we talked about before in terms of stops and trailing stops to protect us if that occurs. Let's you continue to use Zip as a case study here. And hypothetically speaking, we're using my traffic light system. And around about this time here, you can see it goes to the red zone there. And we decide to short sell. The price in the market is about $5, just keeping numbers nice and even. We can see here that to place our stop loss, that now needs to go above our entry price. Remembering that in a short trade, if the price goes up, that's when we're losing the money. Our take profit order needs to go beneath our entry price. And let's just use round numbers here and say we set a take profit at $1. Let's see how the maths works out. Once again, selling first at $5, the price went up to our stop loss at $6. We would lose. If the price goes down to our target there at 1, we would buy. To close out the trade, we would hit the buy button. In terms of the PL, I want you to think of it in these terms. Imagine when you sell, you're getting a credit for the value of the trade. Okay, and in this case, let's assume we're doing a single share for $5, so we get a $5 credit. At some stage, it will cost us amount X to buy back those shares. Clearly, the cheaper we can buy back those shares, the more of our initial credit we'll have left at the end, which will be our profit. Now, in this case, it didn't go our way. The price went up to $6. We hit the buy button and we've got a debit at the end of this trade of $6. So at the start, we had a credit of $5. At the end, we had a debit of $6, which leaves us with a $1 loss. In this case, everything goes our way. Zip falls to $1. Think about how devastated all of the other shareholders in Zip are. You're not devastated at all. You were cheering it all the way down. But your initial $5 credit is subtracted by your $1 debit at the end, now leaving you a $4 profit.